Good morning, ladies and gentlemen. Welcome to Old Mutual's Fixed Income Investor Virtual Update. It's good to see some familiar names on our attendee list, but for everyone's benefit, please allow me to introduce the Old Mutual team. I am Sizwe Ndlovu, Head of Investor Relations and your host for our engagement today. Leading our team is Casper Troskie, our Chief Financial Officer. And supporting him, we have Andrew McPherson, Head of Balance Sheet Management, Ranen Thurkuden, Group General Manager of Finance, Martin van der Walt, Group Treasurer, Sanesh Albert, Head of Capital, Mbali Tubisi in the Office of the CFO, and Sajida Hasim in Balance Sheet Management. Our lead arranger is Nedbank Corporate and Investment Banking, and Ronel and Monique have been instrumental in supporting us in the past and guiding us in making key decisions around upcoming issues. Our agenda for today will begin with Casper providing us with an overview of the year 2020, followed by the financial review of our last reporting period, and we will then cover the DMTN program plans for 2021. We will then allow some time for questions and answers. Given this is a virtual platform, we will allow questions to be asked during the presentation, but only via the chat box on the right-hand side of your screens. Please feel free to use this functionality at any point during the meeting. Should we not get to respond to each question during this session, we will provide you with a written response as soon as possible after the meeting. Please note that we do expect to be coming to market in the first half of 2021, subject to approval from the Prudential Authority, as well as market conditions prevailing at the time. Thank you once again for the time you've taken to be with us today. I will now hand you over to Casper.
Thank you, Sizwe. Good day, ladies and gentlemen. Thank you for taking the time to be with us today, and for those of you who attended the year-end presentation on the 23rd of March. The purpose of this meeting is to provide a brief overview of our year-end results, an update of the subordinated issuance plans for the year, and to answer any questions you may have. The past year was one of extreme crisis and uncertainty. The impact of COVID-19 on human life was immense, and the impact on capital markets and economies significant. In 2020, we were extremely sensitive to the pressures our customers were facing, undertaking meaningful initiatives designed to assist them, their families and their businesses. We also stood in solidarity with our frontline healthcare workers who were battling this pandemic, played the important role of fund administrator for the Solidarity Fund, and pursued various other initiatives across the continent. On the operational front, we redoubled our efforts to make sure our customers kept receiving the high quality of service they've come to expect from us. We enhanced the digital capability of advisors to sell remotely across channels while keeping our staff safe. Our diversified business model proved to be resilient, and we have remained profitable despite material once-off items related to the pandemic. In contrast to the economic slowdown during the year, our product rollout accelerated its pace as our teams all stepped up to take control of our fortunes and those of our customers. From a business point of view, COVID has remained an earnings event and not one that has impacted the strength of the fabric of our business. Our balance sheet remains strong and our cash generation remains extremely solid. The decisive actions we have taken resulted in our liquidity and solvency levels remaining robust in all stress scenarios. As you are aware, the board has declared a final dividend for 2020 of 35 cents per share, consistent with our dividend policy. I would like to share the high-level operational review of our segments. The Mass and Foundation Cluster customer base was particularly vulnerable to the impacts of the pandemic, and we paid out many COVID-related mortality claims. We witnessed solid and sustained growth in productivity and sales from half two, which momentum is continuing. Recovery in the cluster's life sales was robust, and the Q4 result was just under 15%, lower than that recorded in the same quarter of 2019. Similarly, our credit loss ratio has improved following the unwinding of pricing pressure on a cohort of loans granted 18 months ago. Personal finance and wealth management experienced increased demand for risk over savings products, and a growing preference for single premium business. The business managed its expenses extremely well to deliver that flat expense growth from the prior year, while focusing on digital enablement of the sales force in a very competitive environment. Personal finance pre-COVID results for the year include substantial overall net positive basis changes, whereas in 2019 these were negative. However, even without these changes and COVID impacts, the segment's performance was encouraging. I might mention here as well that both Mass and Foundation and Personal Finance have had very encouraging reinstatement rates among those customers who took our offer of premium relief. Old Mutual Investments demonstrated some encouraging trends in 2020. Highlights were good origination in our alternatives businesses, an encouraging net client cash flow performance, which was driven by buoyant retail flows to our income solutions franchise. The first half equity slumped, penalised the segment's equity fund performance following earlier long South Africa investment calls. However, asset values recovered well in the second half, and the short-term listed investment experience has been good. The segment maintained high levels of deal flow during the year, originating more than 15 billion rand, particularly in unlisted equity infrastructure and credit, which will allow it to take advantage of subsequent opportunities. Our group assurance offering in Old Mutual Corporate experienced substantial mortality losses, and the segment was further impacted by a limited ability to generate new business as employers took a cautious view in responding to the pandemic. Old Mutual Insure achieved pleasing growth in most of its business lines, although the underwriting result as well as margins suffered this year. CGIC experienced an unprecedented level of claims in the first half as the economy struggled. But I'm pleased to report that from late August last year, we have seen a sustained recovery in CGIC's business performance, and our digital short-term offering, iWise, surpassed 1 billion in premium income for the first time. The impact of COVID-19 on the rest of Africa has been much lower than that of South Africa, our largest market. We continue to make improvements in our rest of Africa business during 2020. Our property and casualty business showed good top-line growth. Asset management recorded strong inflows, and Malawi continued to achieve good growth, particularly in the life business. Also pleasing was the extent to which our West Africa operation losses have reduced. I am confident that we are poised for growth in this portfolio. Across the business, in the face of everything the year threw at us, our fundamentals, our brands, and our channels remain solid. I will now focus on the financial delivery for the 2020 financial year and will deal with key movements in our earnings. Firstly, results from operations were resilient on a pre-COVID basis at 7.7 billion, 14% down on the prior year. Direct COVID impacts for the full year amounted to 6.1 billion due to an increase in pandemic reserves, business interruption claims, and negative mark-to-market losses in our credit and private equity portfolios. Adjusted headline earnings of 2.5 billion was down 75% on the prior year, impacted further by lower shareholder investment returns and Nedbank earnings. Our group solvency position ended the year in a very strong position, with the benefits of key regulatory approvals and other capital management actions offsetting significant stress from lower earnings and additional provisions raised for COVID. The return on embedded value remained positive despite the substantial provisions raised for the COVID-19 impacts. We have applied a methodology largely consistent with our half-year reporting to identify direct COVID-19 related items. Business interruption and rescue reserve in respect of Old Mutual Insure, CGIC, and rest of Africa include IBNRs of 791 million, which have been provided for. We have included the profit of 293 million relating to the personal lines motor book, given the abnormal circumstances in the year resulting in lower claims. Unrealized mark-to-market losses across the investment, credit and private equity portfolios, which we carry at fair value, had an aggregate impact of 704 million. The impact on the credit portfolio is largely due to the widening of credit spreads during the year. The equity portfolio has seen some fair value adjustments in line with listed sectors impacted by the pandemic. These impacts are expected to reverse as spreads normalize, and we are largely satisfied with the quality of our investment credit portfolio. We have increased our expected credit loss provisions in Old Mutual Finance and Fahulu by 169 million to allow for the deterioration in forward-looking economic forecasts. We have also incurred incremental net expenses of 315 million directly due to the pandemic to stabilize and transition Old Mutual out of the crisis. We raised total reserves of 1.3 billion at the half year. In total, actual claims in the second half of the year were 204 million higher than the provision raised in half 1 2020. With an acceleration in infection in death rates happening in the fourth quarter, we therefore raised additional reserves of 3.9 billion at year end, bringing the total amount provided for to 5.5 billion. Of the 3.9 billion, we had already recorded COVID-related mortality claims of 1.9 billion in January and February, leaving 2 billion rand for future claims. We have released discretionary reserves of 1.1 billion relating to mortality experience in Mass and Foundation, reducing the overall income statement impact to 4.4 billion. We are pleased with the group as well as the OMLACSA solvency positions, which have remained extremely robust. In OMLACSA, the reduction of the Nedbank share price reduced both own funds and the capital requirements. The transfer of the 12.4% of Nedbank shares to OMM further decreased own funds and capital requirements. The Old Mutual Limited 2019 ratio has been represented to reflect the insurance group designation, treating Nedbank as an equity rather than on a Basel III basis, increasing the ratio from 161% to 189%. Both own funds and solvency requirements reduced during the year due to the reduction in the value of Nedbank shares. We are in the process of revising our group target ranges of 155% to 175% for Old Mutual Limited and expect an upward revision of that target range. The actual ratio of 185% is expected to remain in the upper end of our target range. An ongoing recovery in the economy and reduced risk levels could see an acceleration of capital returns to shareholders in the near to medium term. We have come through an exceptionally difficult year in good shape and extremely well equipped to build our core, our brand, our strategy and our strengths. Already this year, we are seeing strong evidence of how our productivity levels are recovering. Our digital rollout stood us in good stead in 2020, and we will keep delivering on digital at pace as we continue with the dynamic ongoing process of re-envisioning Old Mutual. We believe that the disciplined and accelerated execution of our refresh strategy will put us in a good position to win in the market as the economy recovers. While our business was challenged under the pandemic, we are confident that our results from operations and return on net asset value will recover to their 2019 levels by 2023, given good economic tailwinds, possibly sooner. In the medium term, we are targeting a new business margin of 1.5% to 3% across our segments. We anticipate an underwriting margin target will remain between 4 and 6%. By the end of 2022, we are confident of having delivered on our target of run rate cost savings of 750 million. Delivery of this will come from automation and process efficiencies in our core life and short-term businesses. Barring unanticipated risk materializing, we do anticipate an acceleration in the pace of capital returns to shareholders in the near term as we refine our capital ranges. As you are aware, Old Mutual Limited, OMLACSA, and Old Mutual Insure can issue subordinated debt under the 25 billion Old Mutual Consolidated DMTN program. OMLACSA currently has 7.65 billion in issue, and Old Mutual Insure has 500 million in issue. Old Mutual Limited is the guarantor of the last two bond issuances and will be the guarantor on future OMLACSA and Old Mutual Insure issuances. As we have communicated in the past, and given that the markets are favourable, we plan to come to the market each year to raise debt in line with our capital and liquidity strategy under the Consolidated Debt Programme. The aim is to raise debt to optimise the group capital structure and create a smooth maturity profile over time. The subordinated debt will be structured to meet Tier 2 capital requirements specified in the insurance regulation and would be included as available capital in solvency assessments. The group targeted gearing ratio is 15 to 20% of adjusted IFRS equity attributable. So it's on the same basis as we determine our adjusted headline earnings. So we exclude non-core operations, Zimbabwean Residual PLC in that calculation. And that reflects the long-term equity base available to support debt. At 31 December 2020, the gearing ratio was 11.8%, decreasing from 11.2% a year ago, and was below the lower end of the target range, indicating that additional subordinated debt can be issued. OMLACSA currently has 6.75 billion subordinated debt in issue. We intend raising up to 2 billion subordinated debt in 2021, subject to receiving Prudential Authority approval. The timing of this issuance is subject to market conditions, regulatory approvals, and we will consider raising the debt in one of two tranches over the year. We hold sufficient liquidity in core liquid assets to meet coupon payments and maturity proceeds in line with the regulatory requirements. Relative to half 1 2019, interest cover decreased from 18.5 times to 8.7 times, mainly due to a decline in adjusted headline earnings. The level remains above 8 times, the 8 times cover that we managed to, in order to ensure that we protect our credit rating. We expect to come to markets after regulatory approval is received, provided market conditions remain favourable. Should we access the market, OMLACSA will issue Tier 2 subordinated debt with a 5-year tenor under the Consolidated Debt Programme, with OML as the guarantor. Depending on market demand, a fixed or floating rate note will be considered. Given the strength of our balance sheet and our capital optimization strategy, we would consider issuing debt of up to 2 billion, as I said before, in 1 or 2 tranches. The terms and conditions of the debt issuance will be in line with previous debt issuances, and the credit rating of all the OMLACSA subordinate debt issued is rated local scale A+ by S&P Global Ratings. Thank you for your virtual attendance today. We will now deal with some of the questions that have been posted, and will respond to all questions through our advisors.
Thank you, Casper. Thank you, Casper, again. Sorry, and to the team. So we have come to the end of the presentation, and as we did indicate earlier, please do ask questions by raising the hand and using that functionality if you'd like to ask a question orally. Otherwise, then please also feel free to use the chat box that's located on the right-hand side of your screens to ask any questions that you do have. At this stage, we don't have any questions, so we'll just give it a few seconds if people would like to navigate their way through the Teams functionality to be able to do that. Just a reminder again then to all the participants that if you have any questions on the presentation, you may use the functionality available on your screens to be able to ask. And at this stage, we do not have any questions that I can see. Okay. Give it a few more seconds. Okay, if there are no questions, please do feel free to contact us via our lead arranger, Nedbank Corporate Investment Banking, and Ronel and Monique will be more than happy to assist. Casper, I don't know if I can leave you with any closing comments, and then we can close off the call.
No, thanks, Sizwe. Yeah, thank you very much for attending today. And we look forward to obviously receiving our regulatory approvals and coming to markets late in the year. Thank you.
Thank you all. That brings us to the end of the program. You may disconnect.